It's no surprise. There's crazy things happening in the economy. What should we be doing right now? Should we be investing? Should we be in stock? Should we be in real estate? Should we be in neither? We're going to talk about that today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You've worked so hard for your money, and you're now ready for your money to start working harder for you today. You want that freedom, that cash flow right now, not 30 or 40 years from today, but you want to become work optional, where you work because you want to, not because you have to. But more importantly, you're not just here to get rich, but you want to live a rich life. Because as you're blessed financially, as you have more resources and means, you have the greater capacity to bless the lives of those around you. That is the ripple effect I'm here to create, to allow you to create that ripple effect in others' lives. Thank you for tuning in, binging, and sharing these episodes with others too. By the way, guys, if you love this episode, please like and please share this episode with somebody else that you feel that this could help them too, because this show is all about liberating you, because we want 1,000 of you financially free by 2030. So let's work on that together. All right, guys. So I'm bringing a special guest that I've worked really hard to get on for you guys. Okay, so Anna Kelley. Definitely in high demand. This woman, not only has she been, around the block, right? I mean, she's been anywhere from dealing with Wall Street. She's been in the real estate space. By the way, not only has she worked with AIG, but guys, she even has had a portfolio of over $400 million of real estate. And she's a New York Times best-selling author as well. And so really excited to have Anna talk with us today, because this is the thing. What's going on in the economy right now? What's safe? Because I know a lot of you guys are frozen in fear a little bit. You're not doing anything. And sometimes doing nothing could be the worst decision to make in your life right now. So Anna, welcome to our show.
Thank you. I am so glad to be here. We are so well aligned in the way that we think about investing. I started out my career in private banking, actually at Bank of America, and I was
Mhm.
taught all of the traditional, tell everybody about stocks, bonds, mutual funds, insurance policies, et cetera, which there's a great place for all that. But I realized I'm advising a lot of wealthy investors with what to do with their money, but I didn't have any of my own. And I didn't want to take the traditional route like everybody told us to, and I was taught and taught my clients to do, of invest a little bit, for work till you're 65, put it all in the stock market, get your 8 or 9% average returns, and one day when you
Mhm.
retired, you'll have $1 million and live on 4%. Well, that doesn't quite work anymore, and it didn't sound very good to me. So I started looking at alternative investments, specifically real estate. I was working with ultra high net worth individuals and banks and institutions at AIG,
Mhm.
talking to them about retail investments. And we invested in hedge funds and things that were offshore, and a little bit creative private placement type investments wrapped within an insurance policy to make them tax free. But I
Yeah.
realized, like, they already have a lot of money. So it's easy to tell them what to do with money once they had it. But I had to find a path. How can I create wealth starting with nothing and do it much
Yeah.
more quickly? And so thankfully, real estate was what did that for me. And real estate was the thing that was really stable for me through the GFC when I worked for
Mhm.
AIG, and AIG was collapsing and
Yeah.
businesses were collapsing. And I lost a good chunk of my 401. Between 2/3 and 3/4 of my 401k was gone, never to return again. And
So
the
your
only thing
401k
that was
became a
going
101k, huh?
Exactly, barely 101. I think it was about $50,000 left at the time. But the
Wow.
only thing that was going really, really well was people were paying rent. They needed a good place to live. And my rental portfolio was the one thing in my life that was really stable. And so
Yeah.
that was my aha time in life, where I was dabbling in real estate. I was adding to my portfolio, but it was the time when I went, wait, I can't rely on a corporate career, my husband's small business, my 401k. I've got to take my wealth into my own hands. And I went all in real estate when everybody was running away.
Mhm.
And that's, doing that at a time when everybody was frozen, like you said, I don't want to do anything because I'm afraid, was really the key to our ability to grow wealth and build a $400 million portfolio over time. So I'm so passionate about it because I've lived that path.
Yeah.
And I know how important it is to continue to make moves and to take your financial future and your current finances into your own hands, not relying on, totally passive investments in the stock market.
Right. I know it's funny because we debunk a lot of those myths on this show because I used to be a financial advisor, right? And I taught people the same thing, stuff money
Yeah.
away, have your $1 million, live on the 4%. But even 20, almost 25 years ago when I was a financial advisor, I remember we questioned the 4% rule because
Yeah.
that was a rule that was, well, rule, it was never a rule, right? But it was actually made from running the numbers from 1926 to 1976 on those Monte Carlo simulations. But the
Right.
problem was that we're living longer. Inflation's worse since we got taken off the gold standard since then. I mean, so now it's
Much.
it's maybe a 3% rule if you're in your 60s. Even worse for this fire movement that I got kicked out of that group, even though I was fire myself. They kicked me out
Yeah.
because I said it should be a 2% rule if you're younger, and they didn't like that.
Yeah, absolutely. And if you think about that today, I mean, people still
Mhm.
think of, oh, I have $1 million and that's a lot, like I'm a millionaire, but
Yeah.
can you really live on $40,000 a year? I mean, it's poverty level for
Yeah.
most people nowadays. And so, it's like most people are taking a step back if they're shooting for that $1 million where today, I mean, even today where you are paid handsomely to be a saver, you've been
Mhm.
dissuaded from being a saver, in the past because interest rates were so low. Now you're paid to park your money between 4 and 5%. And so even with that, people are living check to check. Even people that make $250,000 a year today,
Yeah.
70% of them are living check to check. And so it just
Wow.
shows you your money goes a lot less far, today than it did back in the 70s, back in the 90s when you and I were in the financial advisory business. And so
Yeah.
times are different, and it's important to understand fundamentals and to really, what hasn't changed is the fundamentals of what is a good investment. How do you determine, what's a good return for the risk that you have and for the cost of living that you have? Like those fundamentals haven't changed, but what you can invest in to actually give you good risk adjusted returns to not only do well today, but do well in the future is very, very different today than it was in the 70s or even in the 90s for sure.
That's for sure. Well, before we kind of go into like whether real estate is still a good thing or not, let's go more to the economy because there's a lot of noise, right? I mean,
Sure.
everybody's cursing Trump, and tariffs and all the negotiations going on right there. And now the market, as of, here early, about mid-May, the market's almost recovered its losses from
Yes.
this first part of the year. The question I have for you is, with all this noise, where should somebody focus their attention? Like, how do you get rid of all the noise and what do you focus on for yourself?
Yeah, I will tell you that it's hard, even for seasoned investors. I'm
Mhm.
50 years old. I've lived through some ups and downs. And I was totally blindsided by 2008 and 2009, even
Yeah.
working for AIG, because I, like most people, was really laser focused on my niche and what I did for a living. And, okay, putting my money in passive funds and
Mhm.
mutual funds, and then buying some real estate. But I got most of my day-to-day financial news from mainstream media,
Mhm.
from CNBC, from Jim Cramer, from my guys at AIG, from our wealth advisors. We were
Mhm.
creating products from advisors of some of the wealthiest people, companies, institutions, and banks in the world. And they
Yeah.
all told me the economy's booming. Don't listen to the
Mhm.
problems in real estate. Yeah, they're kind of at a peak, but it's no big deal. The rest of the economy is strong. Don't bet against America, right? So
Mhm.
I listened to nothing but positive headlines, and I was completely blindsided, as
Yeah.
most advisors and most financial firms were, because they banked on positive. And here's
Yeah.
the thing that I've learned about the stock market wants positive news, and they will react irrationally on any positivity, and they want to discount any negativity and call you a
Mhm.
bear if you see any warning signs. And so,
Yeah.
the market is so disconnected from reality. It's really based upon hopium, right?
Yeah.
And I say you can't invest on hopium. Like,
Mhm.
if you don't know where else to invest, people are just going to invest in the stock market. And they have the mantra of don't bet against America, don't fight the Fed. As long as you stay in, you'll be fine. What's
Right.
happened though between then and now is that between years ago and now is that most of the stock market was picked by looking at the fundamentals of the companies that you're investing in. And a lot of brokers were really good, got really good about picking individual stocks. And when we move to a world of mostly passive investing in ETFs,
Yeah.
Most of those ETFs are very heavily weighted toward a few funds like the Mag 7. Okay. And so
Right.
when you have so much breadth in passive funds, which wasn't the goal of ETFs in the beginning, any small movement in the economy that kind of shocks the system results in really big swings in the market. And so, people are human and we invest on emotion. And it doesn't matter how many times you're told, don't invest on emotion. If it's falling, don't sell when it's down,
Hmm.
don't buy when it's high, kind of DCA. People are moved by emotion. And when they see big shifts, they do panic sell and then they lose. And the other thing with this kind of era of a lot of uncertainty, we have a big shift in the world, obviously, through COVID and through now kind of deglobalization when everything seemed to be global. We're shifting alliances, we're shifting supply changes. There's just so many major shifts on the horizon that people are just listening to any glimmer of hope, or they're listening to the total opposite, just doom and gloom. And so they're making very poor investment decisions. And if you lose a lot today, and I think being in the market generally, I'm anti-stock market right now. I'm just going to be really honest about it, because I think the stock market today is so disconnected from fundamentals. And I
Hmm.
look at what are the PE ratios and are they reasonable? What are the CAPE ratios? Are they reasonable? And if you look at where things are priced today, they're priced to perfection. They expect
Yeah.
a perfect soft landing and the next big boom of AI or whatever it is going to be, healthcare, biotech, you name it, that it's just going to make the economy boom and there's going to be no recession. There's going to be no real negative time. And if you make the wrong decision and you stay too long, or you buy when things are too high and things don't go perfectly, you may not have that time, Chris, to recover. It may take 10, 20 years to recover the losses you take today. So I'm
Yeah.
trying to tell people, don't invest on hopium, but don't also get so paralyzed with fear that you listen to all the negative and not the positive. We have this bias where, and it's a social media
Hmm.
experiment. The more you click on that's positive, the more they will feed you that is positive, that puts that positivity bias. The more you click that's negative, the more they're going to show you the negative. So I don't look at mainstream media because I was led astray and made some really poor decisions in 2007 thinking the economy was going to be great. I really go out and I listen to old guys, right? I wish there
Mm.
was a lot of old women that I could listen to too, but at the time they weren't really, up in the investment space or not well known. But I listened to guys like Steve Hanke, like Ray Dalio, like Jeremy Grantham, who have run billion-dollar portfolios and who have been advisors to presidents for years, who have lived through not only the things that I've lived through, the dot-com bubble and the 2008 crisis and
Mhm.
COVID and what we're going through now.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
But they've lived through the 1970s and 80s crash, the bank
That's
savings and
right.
loan crisis. And I listened to what did they say? What are they watching? And what I can tell you at a high level is when people ask, who should you be listening to? I like shows that interview people who are old and have some wisdom to share.
Mhm.
It's not different this time. As much as there are different things happening that create more risks that we may not see,
Yeah.
there's some pretty strong fundamentals that tells us what trajectory is the economy heading toward and what's the likelihood that we reverse course versus these cycles continuing, that once you end an expansion period and you start to have a contraction and the economy softens, almost always that continues till the trough, till the recession, till the bottom. And what I'm seeing is there are so many signs of slow to no growth, negative growth, recessionary type conditions, that I believe we've basically been in a private sector recession
Mhm.
for a couple of years now. We also have inflation, and we have risks of more inflation with tariffs. But these things are usually really short-lived. And so what I tell people to do is listen to people who are telling you not just where are we today, because if you're making your investments based on where we are today and what the media says, you're missing where we're headed. And you've
Yeah.
got to look at leading economic indicators. That's what we call LEIs, and coincident indicators, CEIs.
Yeah.
Economic indicators, they start to shift about a year and a half usually before you actually hit a peak or a trough. And so I watch, Chris, day to day, week to week, not just where is CPI today? Uh-oh, it moved up a little bit.
Mhm.
Where are layoffs today? Where is unemployment today? That, okay, I can tell you that's real time, but
That's
where
rear
are
view.
things headed? That, we need to look in the back.
Right.
And most of the time you'll see that economic cycles follow a trend
Mhm.
where they start with the housing recession, then they move into manufacturing, and they go into a manufacturing and an orders recession. And then you start to see profit misses in the stock market. Big corporations say, things are softening, consumers are pulling back, we're missing our targets. They miss their top line, their gross income, and then they miss their bottom line, their net income. And then and only then do you start seeing stock market values falling, people saying, uh-oh, we've got big companies that are missing earnings. And then and only then do you start to see companies then start to lay off. And only then you're in recession. And then after that is when you have the big uptick in unemployment. So I
Mhm.
think we're there. We've gone through the housing recession. We've gone through the manufacturing recession. We're starting to see the profits misses and the earnings misses. And
Mhm.
we're in a place that we're nearing the bottom and the trough. I believe we're in a recession today. It just hasn't been called yet.
Yeah.
And these lags from pumping in so much money into the system before we started seeing this softening have
Mhm.
allowed the well-to-do, those that own stocks, to
Mhm.
continue to spend, even when 70% of the population or more is pulling back, check to check,
Yes.
defaulting on credit cards. The consumer is stretched. And so we're near a bottom. But those are the things I watch that tell me that, so that I can drown out the news of, what is Chase Bank saying today our probability of a recession is? Where is CPI? Where is
Yeah.
unemployment? That doesn't matter. They're not
Mhm.
looking at the leading economic indicators that are telling us things are slow. Yes, we're impatient. Yes, there's still uncertainty and volatility, but there's more pain ahead.
Yeah. I love that you said that because I know for me, like I look at different things, because you can always look at like the whole, yield curve. A lot of people talk
Yeah.
about that, but again, it's leading, but it could lead like you
Yes.
said, a year and a half, where we saw it now start to come out of the negative territory and it kind of bounced around a little bit, but it's
Yes.
it's come out of it. So people are like, oh, it's good. No, that usually means the recession's to follow. It's usually not when it's negative, it's in the positive after it came out of the negative, right?
Absolutely. And it is important. I have learned, because I was so blindsided, in
Mhm.
2009, I've learned what are those key things that I'm actually tracking. And one of them is the yield curve. The yield curve
Yeah.
has almost a perfect history of predicting when you're going to come into a recession. What
Mhm.
it can't predict is what actions are the federal government and the central banks going to take to try to prevent that recession from happening. And
Uh-huh.
so I watch things like government spending. So there's some other indicators that I like to look at, like the SOM rule. Some people have looked at that, or the McKelvey rule. And that's a rule that says before you look at the actual unemployment level, what
Mhm.
is the shift in change of the unemployment level compared to the prior quarters? And what the
Mhm.
SOM rule shows us is that when unemployment starts to shift fairly rapidly, even if the total level is low, it almost always predicts that you're heading into a recession.
Mhm.
Another indicator is, out of those that are employed, how much of the new employment was government employees or healthcare
Yes.
employees versus other private sector employment. And so one of the things that we see is that anytime government employs more than 10% of the new jobs created, it's almost a perfect indicator that you're heading into a recession, and they're hiring to prop up GDP just high
Mhm.
enough that it doesn't go negative so
Yeah.
that the economy looks healthy, so that confidence comes up a little bit and it doesn't become this self-fulfilling prophecy. So
They try
we
to create a
saw
positive self-fulfilling prophecy, right?
potentially, right?
Yeah.
So we saw a huge uptick in government hiring at the end of 2023, and it was actually 25% of the new jobs created. So that was an indicator to me, Chris, that, hey, this is a recessionary indicator. The government is spending because the private sector economy is in recession. In fact, the negative job revisions, that's another thing I look at. We see the
Hmm.
headline, oh, we had jobs created. Do you know we had 1 million less jobs created at the end of 2023 than what the original numbers said? And
Yeah.
of that, many of those were gig economy, people taking on multiple part-time jobs being
Hmm.
counted as fully employed rather than how many people are really do we have positive job creation in the sector. So those
Yeah.
are big numbers that I watch, and those have been telling us we're heading toward recession since late 2021. And in fact, if you go out, something if you guys want to start tracking, and you look at the Conference Board's LEI indicators, you can just Google it, and you can see a chart where the LEIs pointed to recession and gave the Fed the warning indicator, we are in recession. And it was there through most of 2022, but
Mhm.
we didn't have that 2 quarters of negative GDP because of the government spending. Then things kind of started to come back because the government offset lack of consumer spending with government spending. But
Mhm.
now those LEIs are pointing sharply downward again and warning. They've actually triggered the recession warning again. So these things are not so black and white, where it's not so important, Chris, that you can say, are we or are we not in a recession?
Mhm.
That kind of misses the point because there's things that can be done to manipulate where we are and give the consumers the confidence to keep spending, giving governments or companies to continue to spend. As long as the government spins you out of it, usually you can avoid a recession from being long and deep. And sometimes you're out of it before it's declared. The important
Mhm.
thing is to say, what's the trajectory of the economy? And however I make my money, whether that's in my job or whether that's investing in real estate or the stock market, what is the likelihood that that will continue to generate good returns, that people are going to keep buying that thing? So, for
Yeah.
example, my husband was a chiropractor before we retired him through real estate. And when the Great Recession hit, people quit coming because their deductibles went way, instead of $20 copay, it was like $5,000 deductibles. People would pop a pill before they would pay $400 to come see my husband. So
Right.
his business suffered because consumers were tapped out, right?
Mhm.
With companies like Apple or Amazon or whoever, if the consumer pulls back, those companies' profits are going to struggle. And if I have rentals, which I do throughout the country, I have long-term rentals, I have short-term rentals. For example, travel is slowing down. What's going to take a hit first? My short-term rentals. What's going to do well? My long-term rentals, where people need a place to live that's safe in an area with low crime, good jobs, and good schools. And so if you can see and figure out what trajectory are we on, and are we likely on more of a slowing economy or a growing economy, I
Mhm.
can make pretty good guesses that this asset type that is a fundamental need, or this company, is going to do much, much better than those that are relying on discretionary income at a time when it's clear that the private sector consumer is struggling and that profits are struggling. So that's all you really need to know at a high level. And then just watch the changes in those key indicators, those key leading economic indicators that tell you how close are we to the bottom.
Mhm. Yeah, absolutely. Great
Absolutely.
stuff. So I think that really does segue into kind of where we're going now, right? Because like you said, the stock market's kind of disconnected from reality, which does make it tough to even predict
Right?
where it's going to go, especially with the Buffett indicator being way higher than it should be, right? As you were mentioning with GDP and whatnot. And of course, GDP is lying because it's really just government spending.
Yes.
So if that starts coming out, with Doge or whatever else, then we start seeing that go out completely off kilter. But
Right.
um, but looking at real estate, like you mentioned, like long-term versus short-term rentals, right? And obviously we've seen probably the worst, I know for a lot of people, probably the worst in a generation, the worst real estate for apartments and commercial and things like that. What would you say to somebody who says, I don't know, I'm pretty nervous. I've lost some money already in some of these deals,
Yes.
and whatnot. What would you say to them now?
This is a really good question. And let me tell you, I've got quite a bit of commercial real estate as well. So I
Mhm.
have not been without a period of pain because when markets shift suddenly, when it seems like it's suddenly, right? Those of us that were kind of watching ahead going, hey, there's a lot of helicopter money. This
Yeah.
usually results in inflation. There's kind of an asset bubble where everything you touch is golden and everybody looks like a rock star.
Mhm.
That was my first warning sign to say, wait a second, this is like probably at a peak. All this money historically has led to inflation. That means if inflation goes up, rates will go up, and values based on rates are going to come down. And that affects most commercial type of assets like commercial real estate. So we saw those warning signs about a year and a half in advance. And hopefully those with experience did some shifting into things like no more bridge debt, no more,
Mm.
short-term deals. Let's buy and hold instead of hoping we can flip in the next couple years.
Yeah.
But the reality is most investors in commercial real estate today have not been around in anything like this before, including myself. So we have to kind
Mhm.
of look at history and say, what can we do? What I will tell you is that we're not at the bottom yet. Commercial real estate still potentially has further to fall,
Wow.
because if the tariffs do become really inflationary, which is the fear, okay, that a
Mhm.
lot of people have that you see in the media, I will argue that in the short term, tariffs are inflationary, but usually if it's preceded by a period of slow growth, they can actually kind of manifest into faster hit to the bottom because consumers just pull back and won't absorb the increased cost. They'll just stop buying.
Yeah.
And so sometimes it can actually be deflationary. You have more competition and less people buying. So if you believe, though, that it's going to be inflationary or just the deglobalization, bringing things back to America in manufacturing, there's a cost to it. And for a couple
Mm.
years, the government's going to have to spend a whole lot of money to reshore a lot of things, which can cause inflation. So
Yeah.
one of the hopes with commercial real estate was recession's going to hit so hard, so fast. The Fed will have to cut rates. Inflation's coming down. And once they cut rates, everybody says it's going to be great again, right?
I
And
called
so
bull on that one a couple years ago.
yeah, me too. And again, you're hoping, right? It was survive to 25, and now I'm like, pray to heaven for 2027, right?
Yeah.
So it's there's still more pain ahead. So if you think that there's a risk of inflation, what you have to realize as an investor is inflation requires the Fed to raise rates. And if you just understand these fundamentals,